What is up, everybody? This is going to be a good one. Super pumped. If you are a public school teacher or a public school employee, let's get rolling. This is all about exactly how you can get into a home. And there was a recently released program through CHFA that changes the game for you if money down payment is a problem. So, we're going to pop into it. Thanks so much for joining Why Invest Wednesday. We are back on Instagram today because I just crossed 1,000 followers on there. So it's been a while over on Instagram, but we are going to get rolling. We're on TikTok, YouTube, Facebook, Instagram, and my Facebook business page. So let's roll. First and foremost, just want to talk to you about this. I want you to know that I was a former public school teacher, and this program jumped out at me. It's near and dear to my heart, and I want to get rolling. So, a Colorado public school employee could potentially receive $87,500 toward the purchase of a $437,000 home. Let that sink in. Not $87,550. $87,500. There are no required monthly payments on that assistance. The second mortgage carries 0% interest rate. So it's just on there. It's a second mortgage. No interest accrues while you own the home. And depending on how the financing is structured, the money can be used towards the down payment, closing costs, prepaid expenses, or reducing the amount you need to borrow through a primary mortgage. This could allow a school employee who is the income to afford a home, but has not been able to save tens of thousands of dollars to purchase years earlier. That is huge, and usually more than they even thought was possible. And this is not limited to the classroom teachers. It may also be available to qualifying full-time counselors, administrators, paraprofessionals, office staff, maintenance employees, and other full-time Colorado public school employees. But there is a catch. Actually, there are several things you need to understand. This is not an $87,500 grant. This money does have to be repaid. It is assigned as a second mortgage. CHFA may also receive a portion of the home's future appreciation, which is the big cost there. Selling costs do not appear to reduce the appreciation calculation. So, refinancing can trigger repayment. Moving out and converting the home into a rental can trigger a repayment. And if the home loses value, CHFA does not have to share in that loss. The full second mortgage is still owed. So today I'm going to break down the opportunity first, then we're going to go line by line through the catch so you can decide whether this program could accelerate your path into homeownership or create an obligation that does not fit your long-term plans. So let's get into it. If you don't know, I'm Jeremy Kane with eXp Realty. I serve Denver and Northern Colorado. I used to be a school teacher, so this is something that I know. I shared in the pain of those low incomes at times, and the just 100% services that you go through as a teacher. And as a thank you, I have a program that I'll talk about at the end where I'm going to tack a little bit more onto this deal if it's the right deal for you, or a conventional loan as well. So welcome back to Why Invest Wednesday. We're going to cut through the headlines and explain what current real estate opportunities actually mean for buyers, sellers, and homeowners throughout Denver Metro and Northern Colorado. This topic is especially important to me because I started my own career in education, as I mentioned, and I understand that gap can exist between serving a community and being able to afford a home in that same community. I also understand how easy it is to see a headline saying, up to 25% assistance and assume somebody just discovered a bucket of free government money. This is not what this is, but it could still be an extremely powerful opportunity for the right person. I also want to say that I am not a lender. I am just a real estate agent who can help you find the home and connect you with a lender who can go more into this. But as a service to you, because I am a former teacher, I wanted to get this out to you guys so that you could understand everything that's involved and so you don't get kind of drugged in for some of those surprises that are certainly a problem as we go. So if you work at a Colorado public school, comment school and tell me the district or city where you work, the general area where you would like to purchase, and whether you currently own a home or would be purchasing your first one. I can connect you with the participating CHFA lender and build a side-by-side comparison between Schools to Home, which is the name of the program, and standard conventional financing. Other down payment assistance programs are available, as well as builder incentives as well. I also want you to know about my Mile High Champions program. Through that program, I offer a 15% rebate to qualifying people who serve our communities, including educators, doctors, nurses, first responders, and military members, as well as teachers. Oh, educators, I said that. For a qualifying school employee, we can evaluate both opportunities. The potential CHFA School to Home assistance, the potential Mile High Champions rebate, the complete monthly payment, the long-term shared appreciation obligation, the amount of cash you would retain after closing, and any rebate must be structured in accordance with the purchase contract, lender requirements, and applicable program rules. We will confirm exactly how it could be used, if it could be used, and how it could change your trajectory of your starting to grow wealth sooner as a teacher. Because the largest amount of assistance is not automatically the best financial plan for you. However, if you're renting right now and you're paying 100% interest, please understand that the 20% appreciation share, we're going to factor all that in and we're going to dive in, but it's all specific to you. So in this video, I can't really go deep into what that looks like. So I'm going to give you the parameters and then we need to talk. You can DM me anytime. If you DM me the word school, we'll start talking about this and we can make sure that it works for you. The goal is to use every legitimate benefit available while making sure the home and financing still support your long-term goals. So, who is this program for? At least one borrower must be classified as a full-time employee of an eligible Colorado pre-K through 12th public school, a public school district, a charter school, institute charter school, Board of Cooperative Educational Services, and Innovation Zone. Only one borrower on the loan needs to meet the qualifying employment requirement. The program is not restricted to first-time homebuyers. The first misconception we need to clear up is that this is not only a teacher program. A full-time public school employee may potentially qualify even if that person is not standing in a classroom every day. So again, teachers, counselors, paraprofessionals, administrators, office employees, maintenance staff, other employees classified as full-time by an eligible public school employer. Employment eligibility still has to be verified. And qualifying as a public school employee does not automatically mean you qualify for this mortgage or opportunity. You still need to satisfy income credit, debt to income, as well as underwriting requirements. This program helps solve the upfront cash barrier. It does not eliminate the mortgage qualification process. According to CHFA, minimum qualifying credit score is generally the greater of 620 or the minimum required by the underlying loan guidelines. The statewide qualifying income limit is $178,920 per year. The minimum borrower contribution is $1,000 and it may come from a gift. So there is no separate CHFA purchase price limits, although mortgage loan limits still do apply. The property must be owner-occupied. Co-signers and non-occupying co-borrowers are not permitted with the program. A CHFA-approved homebuyer education course is required, and the borrower must also complete CHFA's Understanding Your Financial Commitment course. Interest rate buydowns are not permitted under this particular program. There are two numbers that immediately stand out here. The first is $1,000 minimum borrower contribution. That's standard across CHFA's down payment assistance programs. Typically, that makes the upfront savings requirement far more approachable than a traditional 20% down payment or even the 5% or 3% that is required in some of these, other higher loan to value loans. The second is a statewide income limit of $178,920. That means this is not designed only for an extremely narrow low income category. But again, the borrower must still qualify for the entire transaction. The program does not make an unaffordable monthly payment affordable simply by covering the down payment. In fact, it could be higher. So there's a lot to cover here, but this is, as we're going through it, it's an absolutely amazing opportunity for some people that just can't get ahead and they're trying to save money and they're on the rent and their rent's increasing and so on. So what does the school to home package include? A 30-year fixed rate Fannie Mae HFA preferred first mortgage, a CHFA second mortgage of up to 25% of the first mortgage amount, 0% interest on the second mortgage, no monthly second mortgage payment, no accrued interest, no prepayment penalty, assistance that may be used for down payment, closing costs, prepaid expenses, and principal reduction. Borrowers do not have to use the maximum amount of assistance available. So you can use 10%, 15%, whatever that looks like. This is why the program deserves attention. Imagine that you have a stable employment. Your income supports the monthly payment, your credit is acceptable, but every time you begin saving toward a down payment, rent, childcare, transportation, medical bills, and regular life absorb the money. That person may be perfectly capable of owning and maintaining a home. The obstacle is accumulating the cash required to enter the market. School to Home may help bridge that gap. This program may be designed for someone who can afford to own the home but cannot afford to get through the front door. So, as we look at it, we're going to go through this. Let's talk about what it looks like, okay, as a visual, even though it's spoken. $437,500 purchase price. If your first mortgage is going to be $350,000. CHFA's second mortgage is $87,500. Assistance equals 25% of the first mortgage. Assistance equals 20% of the purchase price. This is where the up to 25% headline can become confusing. The program offers up to 25% of the first mortgage amount. It does not automatically offer 25% of the home's purchase price. In CHFA's example, the home costs $437,500. The first mortgage is $350,000. 25% of $350,000 is $87,500. The buyer receives $87,500 through the CHFA second mortgage. That amount represents 20% of the actual purchase price. That 20% number becomes very important when we calculate shared appreciation. The assistance percentage and the appreciation sharing is important. So assistance equals 25% of the first mortgage. The shared appreciation percentage equals 20% because the $87,500 second mortgage represents 20% of the $437,500 purchase price. So what does this mean? Depending on the final loan structure, the assistance could dramatically reduce the buyer's required cash, preserve personal savings for emergencies, reduce the first mortgage amount, potentially reduce mortgage insurance exposure depending on the final loan to value and underwriting, help the buyer purchase sooner, help a school employee live closer to work, allow the buyer to stop waiting years for a traditional down payment. That opportunity matters. Waiting is not financially neutral. While somebody is saving, home prices, rent, interest rates, and life circumstances continue to change. A program that creates access today may be worth giving up part of the future appreciation. But now we need to turn the page because getting into the home is only half the story. The other half is understanding how do you eventually get out of the obligation. Everything we have discussed so far is the exciting part. You may receive tens of thousands of dollars. You do not have to make a monthly payment on that assistance money. You do not have to pay interest on the assistance money in the second mortgage. The assistance may allow you to become a homeowner far sooner. Now let's discuss the catch. And I do not want to use that word to imply that CHFA is hiding anything. CHFA requires an entire financial commitment course because the agency wants borrowers to understand this obligation. The catch is simply the trade you are making. You receive significant assistance today. In exchange, you agree to repay that money later and potentially share part of the home's appreciation. Here are the 8 things every borrower must understand if you're going to look into this product. The $87,500 in our example is not forgiven after 3 years like some of these down payment assistance grants. It does not disappear after 5 years. It is a deferred second mortgage. The second mortgage carries a 0% interest and does not require monthly payments, but the principal remains attached to the property until it is repaid. Full repayment is triggered by events that include selling or transferring the home, refinancing the first mortgage, paying off the first mortgage, paying off the second mortgage, no longer using the home as your primary residence, reaching the end of the loan term, and certain defaults under the loan documents. No monthly payment does not mean no debt. It means the payment has been deferred. When a repayment event occurs, CHFA calculates whether the home increased in value. For a standard arm's length sale, appreciation is generally calculated by subtracting the original purchase price from the actual resale price. The shared appreciation percentage is not calculated by dividing the original CHFA second mortgage amount by the original purchase price. Original purchase price $437,500. CHFA's second mortgage $87,500. Shared appreciation percentage is 20%. Future sale price is $480,000. That means it appreciated $42,500. That means $8,500 of the $42,500 is CHFA's share. Plus, you must repay that original second mortgage of $87,500. So you owe CHFA $96,000 when you sell the home. The homeowner does not give CHFA all the appreciation. In this example, CHFA receives 20% of the $42,500 increase. The homeowner keeps the remaining appreciation subject to the first mortgage, second mortgage, and transaction expenses. The more assistance you accept, the larger percentage of future appreciation you may agree to share. And remember, the borrower does not have to accept the maximum available amount. That becomes a major planning decision. This is one of the most important details in the program. CHFA calculates appreciation from the increase in the property's sale price. The official documents do not appear to subtract real estate compensation, seller paid closing costs, repairs, title expenses, or other selling costs before calculation appreciation. Those costs reduce what remains in the homeowner's pocket, but they do not appear to reduce CHFA's appreciation calculation. Suppose you originally purchased for $437,500. Later you sell for $457,500. The sale price increased by $20,000. You assume your shared appreciation percentage is 20%. CHFA's shared appreciation payment may be $20,000 in appreciation multiplied by 20% equals $4,000. Now suppose you also paid $20,000 in compensation, closing costs, and other selling expenses. You may feel like you made a no actual profit, but CHFA would still calculate the $20,000 in appreciation based on an increase in the sales price, creating a $4,000 shared appreciation payment. CHFA calculates its share from the increase in the home's value, not from the profit remaining after you sell it. This makes a short ownership period very dangerous. Even modest appreciation may be consumed by transaction costs while the shared appreciation payment still becomes due. There is good news here. If the home does not appreciate, the borrower owes no shared appreciation payment. The borrower still owes the entire outstanding CHFA second mortgage principal. For example, if the home was purchased for $437,500 and later sold or valued at the same $437,500, appreciation is zero, the shared appreciation payment is zero, the full remaining second mortgage still has to be paid in addition to real estate fees. No appreciation means no shared appreciation payment. It does not mean the second mortgage disappears. Normal selling, refinancing, appraisal, valuation, title, and recording costs may still apply depending on how repayment occurs. What happens if the home goes down in value? CHFA treats negative appreciation as zero. That means the borrower does not owe a negative shared appreciation amount, but the second mortgage is not reduced. So using that official example structure, original purchase price is $437,500. Later, the value is $425,000. Property decline $12,500. Shared appreciation is zero. CHFA's second mortgage is still owed. Remaining equity may be negative before the transaction expenses. CHFA shares in the upside, but the homeowner carries the downside risk. That does not automatically make this a bad program. Most traditional lenders do not reduce your mortgage because the market declines either. But it means this program requires a realistic expected holding period. Buying today with the expectation of moving again next year could create substantial risk. A borrower should not assume, I will use this program now and simply refinance when the mortgage rates falls. Refinancing the first mortgage is a repayment event. At that point, CHFA calculates the shared appreciation using an appraisal or another qualifying independent valuation. The borrower generally must repay the outstanding second mortgage principal, any calculated shared appreciation, applicable refinance, appraisal, and title and recording costs as well. A future refinance may require enough equity or cash to pay off the CHFA obligation first. That could affect the borrower's ability to capitalize on lower rates. A lower mortgage rate may look attractive, but the refinance must still work after accounting for the second mortgage and shared appreciation. This is why we need to compare long-term plans, not just the payment on closing day. The property must remain in the borrower's primary residence as well, while the Schools to Home second mortgage remains outstanding. The published materials do not provide a 1-year, 3-year, or 5-year occupancy period which the borrower can freely convert the property into a rental. If the borrower stops using the home as a primary residence, that becomes a repayment event. You could live in the home for 5 years, but if you then move out and rent the entire property, you do not automatically get to leave the Schools to Home second mortgage in place. You need to contact CHFA. The second mortgage and any shared appreciation calculated from the property's current value may become due. Because there is no sales price, an appraisal or another approved valuation may be used. This is a primary residence homeownership program, not a shortcut into your next rental property. The published materials do not clearly answer whether a borrower may rent a bedroom, basement, accessory dwelling unit, or another portion of the property while continuing to occupy the home as a primary residence. That situation should be confirmed in writing with CHFA and the participating lender before the borrower relies on rental income or begins renting any portion of the property. The program also permits borrowers to use less than the maximum available assistance. That may be one of the most important planning opportunities in this entire program. Suppose you qualify for $87,500, but you only need $52,500 to make the purchase work. Accepting less assistance could mean a smaller second mortgage to repay, a smaller shared appreciation percentage, and more equity remaining when the home is sold or refinanced. Do not ask only how much assistance can I receive, ask how much assistance do I actually need. The goal should not be to maximize the borrowed amount. The goal should be to use the smallest amount that creates a sustainable home ownership plan. If you work in Colorado Public Schools, comment school and tell me where you work, where you would like to purchase, your approximate timeline, and whether you expect to remain in the home long term. If you want to put that in the DMs, that's fine too, or the comments are great. Thank you so much for everything you guys do, for real. I can connect you with a CHFA participating lender and help you build a complete comparison showing all of these things: estimated purchase price, first mortgage amount, potential CHFA assistance, cash required at closing, estimated monthly payments, mortgage insurance, shared appreciation percentage, potential repayment at a different future home value, standard conventional financing alternatives, other CHFA programs or DPA programs, builder incentives, and your potential Mile High Champions rebate. Through Mile High Champions, I offer a 15% rebate to qualifying educators and other people serving communities, including nurses, doctors, first responders, and military members. That 15% is based off of my commission, not the total purchase price, unfortunately. That would cost me a lot of money. But we will confirm with the lender and the title company how that rebate may be properly applied within your particular transaction. The goal is not to simply qualify for the home. The goal is to understand the complete opportunity, use legitimate benefits available to you, and avoid creating a future obligation you are not prepared for. So you may ask, who would be a strong fit? That sounds like a lot, Jeremy. I don't know if it would work for me, but someone who has stable full-time public school employment, has the income to support the mortgage payment, has acceptable credit, lacks a traditional down payment, plans to occupy the home for several years, is comfortable sharing some of the future appreciation, wants to preserve emergency reserves because they can bring less cash to the table. They don't expect to refinance or convert the property into a rental quickly, and has compared this structure against the conventional alternatives. This may be especially powerful for someone who is financially ready to own but has been locked out by the upfront cash requirements. The program can potentially replace years of waiting and renting with an opportunity to build stability now. Who should be cautious? If you expect to move again soon, want to convert the home into a rental, plans to refinance immediately when rates decline, has enough savings to purchase conventionally, is uncomfortable with a large future balloon obligation, wants to retain all future appreciation, is buying at the absolute limit of affordability, has no emergency reserves, is purchasing a home with short-term resale risk. I always say, especially for the emergency side, homes that we purchase break. So understand that if you're putting every last penny you have into a home, that's going to be a problem, and we want to probably make different plans, and that's what I do for my clients all of the time. The program solves the upfront cash problem. It does not solve every affordability or long-term planning problem. So questions you should ask before using the School to Home program. How much assistance do I qualify for? How much assistance do I need? What is the interest rate and APR on the first mortgage? What is my complete monthly payment? Will I have mortgage insurance? How much cash will I retain after closing? What percentage of appreciation will I share? What happens if I sell in 3 or 5 or 10 years? What happens if the home does not appreciate? What happens if the home loses value? Do selling costs reduce the appreciation calculation? What happens if I refinance? What happens if I move out? Can I rent any portion of the home? How does this compare with standard conventional financing? How does it compare with other CHFA assistance? Are builder concessions or family gift funds available? How can my Mile High Champions rebate be used in addition to the CHFA School to Home program? Does this structure fit my actual long-term plan? Those are the questions you need to ask. If you need access to a CHFA qualified lender, please, let's look at the numbers. Let's see what makes sense. I didn't do any of this to scare you, but that's what we have to do in the next step so that you can see everything, compare apples to apples, and absolutely take advantage of this opportunity if it's something that works for you. If you're a Colorado public school employee and want to see what this program could look like using your real numbers, comment or message me school. I will help connect you with that participating CHFA lender and compare all of those things and get those answers to all those questions. Again, through Mile High Champions, in addition to this program, I rebate 15% of my commission to qualifying educators, nurses, doctors, first responders, military members, and members who serve our community directly. We'll determine whether you qualify and how the rebate can properly be incorporated into your transaction under the lender, contract, and program requirements. You do not need to make this decision based on a headline saying 25% assistance. You need to complete a financial picture showing, complete financial picture showing what you receive today, what you may owe later, and what additional benefits that may be available to you. Before you make a move into, out of Denver or Northern Colorado, call me or text me 303-543-1453 so we can build that plan first. If you know a teacher or you know somebody that works for the public school system, please share this video with them and hopefully we can help them out if it's something that works for them. Here's the position I want you to leave with tonight. CHFA Schools to Home could be a life-changing opportunity for Colorado public school employees, but it is not free money. The program may provide tens of thousands of dollars towards purchasing a home. The second mortgage does carry 0% interest. There are no required monthly payments on that assistance. No interest accrues. And the money may allow someone with stable income, but without a traditional down payment, to become a homeowner years earlier. That is the opportunity. The trade is that the assistance must be eventually repaid. When you sell, refinance, pay off the mortgage, or stop using the property as a primary residence, the second mortgage becomes due. If the home appreciates, you may also owe CHFA a portion of that appreciation. Selling expenses do not appear to reduce the appreciation calculation. If the home does not appreciate, you owe no shared appreciation payment, but you still repay the second mortgage. If the home loses value, CHFA does not share the loss. There's also no published waiting period after which you can automatically move out and convert the property into a rental while leaving the assistance in place. But for qualifying educators, there may be another benefit available through my Mile High Champions program. That means we can evaluate CHFA assistance, the potential Mile High Champions rebate, and other legitimate options available to you, not to force a transaction, not to chase the largest headline number, but to determine whether homeownership makes financial sense for you. This program is not automatically good. It's not automatically bad. It is a financial trade. The correct question is not, can I get $87,500 The correct question is, would receiving this assistance today, along with any other benefits I can qualify for, put me in a stronger financial position after accounting for repayment, shared appreciation, my expected home ownership period, and my long-term plans? For the right public school employee, the answer may absolutely be yes. They may gain stability. They may live closer to the community they serve. They may preserve more of their savings, and they may begin building equity instead of continuing to wait. For somebody expecting to move, refinance, or convert the property into a rental quickly, a different financing structure may be safer. Comment school, share this with your favorite teacher, and send me a direct message, and we can have a conversation and determine what opportunity is best for you. We will compare the complete numbers, we'll explain the obligation, we'll determine whether you qualify for the Mile High Champions program, and we will make sure that financing supports the life you are trying to build. Reach out with any questions about Denver and the suburbs, and if you are exploring areas to move before you move into, out of, or around Denver Metro or Northern Colorado, let's build a plan first. I will see you next Wednesday, and please understand that a lender can look at this information, a qualified mortgage professional, and help you make the right decisions. They'll be able to answer all of the questions. I just wanted to bring you the idea of the program, talk about a couple of the pitfalls that may exist. And if you are not in the state of Colorado and you just watch this whole thing, please reach out. I can look into connecting you with somebody in other states and see what programs exist for you. So we'll see you next Wednesday.